Is there any talk of a debt jubilee? Would that be?
Well, it's Bitcoin.
Okay. Well, yes, but
because Bitcoin blows up the debt. Okay, when you're looking at Bitcoin's performance on a long enough time frame versus what people would go to as safety, which was the bond market, and that gets so far upside down. Like right now, 5% people sitting on that fixed income desk, they're saying, "Oh, this is really bad," but eventually the Fed's going to do things, and it's going to bring, you know, inflation down, and like we'll be in the positive again in nominal terms and in real terms. But what if it doesn't? What if it does the opposite? And for me, that's my base case, is that you're going to continue to see these inflation prints and these supply chains continue to break down, and they're not going to be able to get it under control. And they're going to then implement yield curve control, which means that they're going to peg the yields at 3% because people who own homes can't afford for it to go any higher, right? Because everybody's in debt up to their eyeballs. So if they're pegging those yields at really low interest rates and you got this massive spread because supply chains are breaking down, you have to ask yourself, how long can people in the fixed income space, the bond market, sit there and eat a -5 or a -10% return before they say, I'm not owning that and I've got to own something else? And then all that monetary energy shifts continues to shift itself into this thing called Bitcoin.
And do you think we're seeing any of that? Because at the moment we seem to be like a correlated risk asset.
You're seeing that because the market cap is a pittance in Bitcoin. Relatively speaking, like we're talking about $100 trillion markets in fixed income versus Bitcoin. It's, I don't even know what it is, 700 billion right now or something.
Yeah, something like that.
I mean, that's just a joke.
Yeah.
In relative size. So, you know, I asked Luke Roman a similar question, like, so where do we start to see that pivot kind of start happening? He thought it was around like 20 trillion in a Bitcoin price that would then really start waking up the market, and the market just like, all right, so clearly this goose is cooked. Yeah.
All right, Danny, let's go forward
go forward. So this is the US. And so when you go back one real fast, Danny, so this was the US's response. But my point was, this just isn't happening in the US. So like going back to the monopoly example, let's say we have 5 boards instead of just 2. And it's not just one central bank that's inserting, it's all 5 of them. And then it starts getting to a point where things get so unstable that now the central bankers are standing up. Let's say there's 5 different boards. The 5 central bankers are standing up and they're like, all right, this is getting unstable, right? I'll debase for the next, 10 moves, and then you debase for the next 10 moves, and then you debase for the 10 moves after that. And it becomes this global coordinated, think BIS, WEF, IMF. What the hell do you think they're actually doing behind closed doors, right? They have to keep this coordinated. So go to this next slide. Okay, so you're going to see that there's times when the Fed is debasing pretty hard, and sometimes when the ECB is debasing pretty hard. Okay, and so there's the Fed, the European Central Bank, Bank of Japan, and the People's Bank of China, the big 4 central banks. Okay, so now what if we could take all of those lines, smush them into a single line, market cap weight them for the value of that currency, and go to the next slide, and that's this. And that's what it looks like. And it's this fairly smooth line. You can see that at the start of 2018, they collectively, as a global coordinated body, unelected global body, tried to start to I wouldn't even call that tightening. I would call that normalizing, is what the attempt was.
Right.
And so you can see globally they were trying to normalize together. And so that's where you're seeing it go there. And then all of a sudden COVID happened. But if you went back and you really drilled into the charts prior to COVID, they were already, you can see a little bit of the bump there in the line. This market was already going into a recession. They were already globally starting to ease again. Go back a slide, Danny. You can see it here real well. Look at the Fed in mid 2019. COVID didn't happen until 2020.
Yeah.
Right. You can see they were already starting to base. Every one of them were starting to base except for the ECB. And I would say that's whenever it was going to start picking up again, whether COVID even happened.
So go to the next chart. So what we've seen, we've seen a dip now here in this total assets of major central banks over the last, is that basically the last 3 months or the last month?
Yeah, it's really from the start of the year.
Right. And okay. And that's why we've seen equities get absolutely smashed.
Absolutely hammered.
You know, Bitcoin hasn't survived, but that's a signal of where we're going.
I'm stacking cash since the start of the year.
Interesting.
Yeah.
So you're waiting.
I have a couple posts. You can go into Twitter and you can find them.
Well, you told me this in Miami, though.
Yeah.
You said there's going to be a time to jump into equities.
No, that's way down the future.
Okay.
Yeah.
So what are you stacking cash for?
For me, it's a cash Bitcoin world.
Okay.
It's the dollar and it's Bitcoin.
Okay.
And so when I saw this, and I pay very close attention to these charts, these central bank moves, because they're inserting fiat units into the game, back to the monopoly. You have the central bankers that are adding units into the game, or they're clawing units out of the game, or they're allowing the credit, which only makes that example more confusing. And I can kind of explain that if you guys want to get into it. But when those credits, or when those units are being clawed out of the game, the value of everything has to go down relative to those units.
Yeah.
And so when I saw the central bankers collectively at the start of the year, they had this massive negative spread in fixed income. I knew they had to get it under control. This is them trying to get it under control. And they have to let impairment happen, which is the promises between individual entities. They have to let that blow up, because that's money basically disappearing out of the game. And then they're clawing units out of the game. And so when they're doing that, you want to be long fiat, believe it or not. But it's going to be a very short-lived holding period. Like if you talk to me in 3 months from now or 6 months from now, and I wasn't stacking fiat and I was stacking Bitcoin again, that shouldn't surprise you.
Okay, I had this conversation with a few people now. I've heard a few times now. There's the belief that they're going to be raising interest rates up until the midterms, and then about September is about the time to perhaps be buying Bitcoin. But Bitcoin's going to get hit with these interest rate rises over the next few months.
The thing I would watch for is the headline in the Wall Street Journal for something like central bankers add 3 trillion, 5 trillion, 10 trillion collectively into the global economy with yield curve control. And I don't think it's going to be that. I think it's going to be more QE and UBI. And it's going to be UBI in the form of offsets with the fuel, the energy expenses, and just everyday, anything that is an everyday expense, they're going to be providing some type of offset to that. And they're going to have to do it through, and they won't be calling it, they most likely won't be calling it UBI, but it's UBI. It's, hey, if it costs $5 to fill up a tank of gas, per gallon to fill up a tank of gas, now it's $2 because of some socialized $3 offset, which is UBI.
Right. And that's the time to be stacking Bitcoin.
If they're doing it at a scale that is in the trillions. Right. If you're talking like, if it was 1 trillion, I'd probably be a little hesitant to say that that's the pivot point. If you're talking like 5 to 10 trillion, then I think that that's the reversal of their activity. I think it's going to be very obvious.
5 to 10 trillions, doubling the balance sheet again.
Yeah, exactly.
That is going to tighten the band even more.
You're providing a narcotic to a dying patient.
Yeah.
Yeah.
Have you actually run through how it all eventually blows up?
I mean, the blow up is in bonds. And so what does that mean, and what does that mean to who? And so for I don't want to go too far, because any person who says that they know how this is going to play out, I think you've got to be very suspect listening to what they have to say.
Yeah, but it's scenario planning.
Yeah, generically, I would say if that scenario plays out, because that's what's going to provide the relief to the normal person who's in debt up to their eyeballs, is if you own a house and it's 90% levered, and all of a sudden that currency that contract says blows up, because you own a house that says you're going to pay it back in pounds. Mine says I'd pay that back in dollars. For people that have that liability on their balance sheet, and the currency now looks like everybody's pivoting and using something else, that's going to be the thing that provides relief to that person, because it's going to get easier for them to pay that 30-year mortgage back when they're getting paid in something that's aggressively appreciating in value,
like Bitcoin.
Okay, now where the challenge comes with this scenario is you're going to have a lot of dislocation in just business enterprises in general because of this shift, and because not every business is going to be able to figure it out.
It's musical chairs, right? You got to go and get chairs.
That's right. And so if you're in a job, let's say you're employed and you have a job in something that is highly sought after, regardless of what the economic circumstances are, a depression-like scenario or a booming economy, and you're always employed, you're going to be able to make this transition a whole lot easier than a person who has a job that isn't going to perform so well in a depression-like scenario. So that dislocation is what's going to make it hard for the person who's in debt up to their eyeballs. They don't have a job to collect the Bitcoin, right? But the person who can sustain a job and can pivot to owning this new currency, it's just going to get easier and easier for them to make the payment on that house.
So this is probably going to lead to a lot of civil unrest.
Yeah, I think that this is going to lead to civil unrest. The scale and the magnitude, I think, is highly dependent on the speed of the transition. So if this would blow up quickly, I think that you're going to have way more dislocation. If this happens slowly over, call it a 5 or 10 year period of time, I think the dislocation could be handled much more. Ray Dalio calls it a beautiful deleveraging. I would never use those terms.
Because it doesn't feel beautiful.
There's nothing beautiful about it.
It's a horrific deleveraging.
For most people, yes. On a net basis, it's not a beautiful anything.
And so is it as simple as the bond market switches over to the Bitcoin market?
So you're just going to find that the owners of the bond market, you have to ask, like, it's a store of value, right? They're just storing value. They're not really trying to crush it. They're not trying to outperform anything, because they're clearly not. I mean, they have for the last 40 years because they just keep getting bid. But here in the short term, they're going to find out that it's slowly disappearing, that it's a store of value and that it keeps going up. And so that's where the transition's going to come to Bitcoin, where it's a store of value and it keeps going up on a long enough time frame, and the over time will start to it'll start getting better, but it's not going to be for a while. You got a lot of time left before I think the volatility is going to start calming down.